Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. All right, we've been talking about a lot of different things this morning, and all about investing is what this comes down to. So we'll go back to the three worlds of investing, and let me show you on that third world we were going into about the stock market. One of the things there I mentioned about individual stocks, bonds, mutual funds, in addition variable annuities I had ended with. So there are, when you look at annuities, there are basically three categories that we want to talk about. One of them being fixed annuities, and a fixed annuity is basically like a CD. That simply means that I'm going to get a set amount of interest for a set period of time, and then I can basically take my money back, or I can, if I like the new rate, maybe I'll renew it. You know, that's my choices, much like a CD, as I said. Now, a variable annuity is like mutual. It has sub-accounts, and those sub-accounts work like mutual funds. Basically, they're same managers, same companies, just like a mutual fund. And we're going to have the same kind of expenses. We're still going to have the same risk that we have in the market. So what's the problem with variable annuities is they also have higher fees. So I'm adding fees. If I'm going to invest in the stock market, and I'm going to take on that risk where I have no guarantees, right? My interest, my principal, none of that's guaranteed, and I need to leave it in there for a while if I want an assurance that I'm going to have a positive result. So that's the way the stock market works with what we're looking at with volatility and the fluctuations in the market. So with variable annuities, I don't want to invest that way in the market. If I'm going to take on that risk, I want to keep my costs low, and I want indexing strategies. And that's the other part about variable annuities, is not only do they have higher fees, but they limit me, right? Because what can I invest in? I can only invest in the sub-accounts that they have within them, where if I go outside of that variable annuity, I'm not restricted in that same way. Now, what are one of the advantages that variable annuities and all annuities have is that of tax deferral, and that's where sometimes people will go into them looking to defer taxes on money. Now, of course, if you've got IRAs, or whether traditional IRAs or Roth IRAs, you've already got that tax benefit, so you don't really need that part. And if you're looking to get the tax benefit, well, there are better annuities than variable annuities to invest in. And that brings me to the third kind of annuity, which is an index annuity. An index annuity, and they also have what are called index CDs, by the way. But the index annuities have been around longer, and they typically have better strategies that you can employ with them, better sub-accounts to work with. Now, an index annuity basically starts with all the guarantees. These are fixed index annuities, so we go with that principal guarantee as an example. We don't have to worry about losing money in the market as we would when we're investing in, say, a variable annuity as an example. So with a fixed index annuity, I'm going to have the safety of principal guarantee, and I'm going to have a link to the market through an index. Now, that might be an S&P 500 index, it could be a Barclays Aggregate Bond Index, Dow Jones Industrial Index, or we see newer indexes coming out, such as the Mosaic, JP Morgan Mosaic, the Schiller Index, the Zebra Index. There's a number of them that different banks have put together partnering up with insurance companies to bring those to market. And these are what we're seeing with some of the new indices is ways to control volatility while, again, attaining higher rates of return. So these are ways we can stay ahead of inflation and taxes. And one of the things to look at when you're investing is how they may or may not play into your investment strategy. But those are the three worlds. That's how, when it comes to investing, to stay ahead of taxes and inflation, this is one of the areas we get into. Now, the next slide, we talk about your basic roadmap, and that goes into what I was talking about before. So if we take a look at the next slide, there we have we call it the roadmap, and this is what I was talking about: your operating fund, about 1 to 3 months worth of expenses; your emergency fund, 6 months worth of expenses; your short-term fund, which would be, depending on what your short-term financial goals are going to be in terms of expenditures and stuff that you may have over the next 3 to 5 years; and then your long-term fund. And your long-term fund is where we want to make enough to stay ahead of inflation and taxes, and again, enough so not just on the money that's in there, but on the money that we also have in the safe world. We want to make enough to make up for that piece of lost return, as well as on the, in other words, think of it this way: if I've got anywhere from maybe $50,000 to $100,000, give or take, in my short-term fund, all right, well, that's money that is earning 1%, give or take. So it's not staying up with inflation and taxes. Now, if it's short term, it's going to be used or potentially used, not as big a concern, and we need that liquidity, in other words, access to those funds, so that's the trade-off. But when we look at our long-term fund, then we incorporate that into it, and we say, well, we want to make sure that we're making enough on our long-term funds to make up for the lost return on those short-term funds as well. So it's the considerations there when it comes to needed rate of return. That's part of it. When we do a report for new clients coming in and we're showing you your financial future, that's a consideration as well, right? We want to make sure we're looking at the bottom line. How much money are you going to have based, how much do you have today? What's your starting point as far as your assets, retirement accounts, that kind of thing? And what's that going to look like 10 years, 20 years, and on down the road? Are they going to grow? Are you going to be okay in terms of being able to draw the income you need and not have to worry about running out? We're going to make sure of that. I do that with new clients, with my clients, and when we do reviews and that, we keep you on track to make sure that'll never happen as well. So, in fact, let me stop for a moment again. Before I do, income and inflation, or excuse me, taxes and inflation are what we're concerned about. That's why we want to get that above 4% earnings on that money. Many times we're looking at plans that typically 6-7% or more, depending on what the goals and needs of the individual are. And that money, as you can see, that's going to provide the income needed when those checks go away, right? When the payroll goes away, how are we going to get the money we need to live on? And that's how we do that. All right. First 10 callers, let's put it out there again. For the first 10 callers to my office this morning, Tess is standing by to get your information. 615-376-5325. Would you like to see your financial future? Would you like to know that you'll be okay in the future, or you're concerned? One of the biggest concerns I hear voiced so often is that people are worried about running out of money, right? We're worried about, are we going to, when we get to a point where we can't go back out maybe and replace it, that we find ourselves short. So we want to make sure, can I retire when I want to retire? Am I going to be okay and not have to worry about running out of money? And in fact, all those questions get answered as a part of doing the reports that we do for you. So if you want to have this type of work for your specific situation done, be one of the first 10 callers, 615-376-5325. Tess will get your information. She'll send you out a checklist of things to bring to your appointment with me, and we'll do this work for you. We'll do an investment analysis. We'll do again, that financial future picture. We'll show you that report that's an income analysis, and we'll also do we'll talk about estate planning. We'll get into tax planning. We get into all the different areas that are going to, Social Security, Medicare, all the different things that are going to affect you financially. We're going to talk about, and how in fact to plan for those. So again, first 10 callers, 615-376-5325. And when you come in to see me, I'll give you a free copy of my book, 7 Steps to Financial Freedom and Retirement. And in the book I go into this is basically my practice over the last almost 30 years, and different clients that I've worked with, and how we've used planning to help them. And we talk about some of the success stories there. We also talk about some of the strategies that we've employed with them, these proven strategies to help you attain your goals. All right, now one of the things I want to share with you as well, and this goes back to when it comes to your investing. I've talked about annuities a little bit here and there. And it's not that, for some people that are really risk averse, annuities may play an important role for them as a way that they can safely invest and get bigger returns on their money. The other part comes into when we're looking at investing in as far as a portfolio goes. Traditionally, we think of things like stocks and bonds, and if we blend together bonds with stocks, that we can help reduce our overall volatility or risk in the stock market. And why? Well, stocks and bonds, one of the things is understanding how they work. They have what's called a negative correlation. Typically when stocks are really on a run, like we've had this nice strong bull market, the second longest bull market in history, in fact, and this has been going for almost 10 years now, right? So what do we see with that? What we see is that when the market's going like that, bonds are not typically going to keep up with that type of growth, right? Stocks are going to outperform. But when the stock market goes in the other direction, we've had 2 bear markets in the last 20 years. From 2000 through 2002, we saw a 45% reduction, right? A 45% drop in the market over that 3-year period. And it took about 5 years for it to recover. So that means you were in the market for almost 8 years just to get back to where you were at the beginning of that period. And what happened then? When it peaked out in about October of '07, and then the market took another hit, and we went into another bear market cycle from October of 07 to March of 09. Over that 18 months, we're looking at a drop of about 55% in that period. So here we've been in the market now we've been in the market for 10 years, and we basically have less than what we started with 10 years before. Now that's unusual. That lost decade, as it's referred to, very unusual as far as the markets go. But bear cycles are not. Bear and bull, cycles happen all the time. So what we want to be looking at is how to weather those kind of things and how to invest in such a way that, for instance, a moderate portfolio and the way put together, again, with stocks and bonds, because what happens when those stocks go down? Well, our bonds help soften that a little bit so we don't lose as much. Asset allocation can go even further, and the types of companies, the types of stocks that we hold can help us reduce risk as well, reduce volatility. For instance, a moderate portfolio, 50-50, is one of the moderate and model portfolios that I would be able to show you. And these portfolios from 2000 through 2002, when the market dropped 45%, it was basically, they were down less than 1% over that period. So needless to say, it didn't take them 5 years to recover. The very next year, they were making you money. And over that 10-year period, they actually averaged, I believe it was around 6% a year over that 10-year period when the market lost money. So asset allocation is a very important part of your strategy to make sure, in fact, that you're going to be able to stay ahead of inflation and taxes, and softening that volatility utilizing these models. And this comes from Nobel. We have 60 years, in fact, of Nobel Prize winning academic research showing us how to construct a portfolio to where we can get that type of market return while minimizing risk. All right, and this is so important, especially when you're retired and you're starting to take money out. Controlling volatility can be the difference between running out of money and having that life of ease and style that you want in retirement, where you're, again, thriving, not just surviving. So it's so important to understand these principles and how to apply them in your situation. All right, we got to take another break, so join me here. We'll be right back on the Retirement Report.